On today's episode, we're going to dive into what's happening today in the multifamily investment market with one of the top brokers in the country. With me today is Tyler Hague, who's a multifamily investment sales broker. Welcome.
Thank you.
Listen, everybody, we all know that real estate is the most proven way to build wealth. But why isn't everyone wealthy from real estate then? It's hard to know where to start, and most of the education out there is just complete trash, and you end up investing your money on a series of courses instead of in real estate. That's not how this podcast works. We give you the blueprint to successful real estate investing and bring on guests actually willing to share their secrets. I started my real estate investing journey as a freshman in college when I bought my first duplex and have been in the trenches doing deals ever since. And today, I now own hundreds of millions of dollars of investment property. On this podcast, you will learn what you actually need to know to be a successful active or passive real estate investor. And we'll offer our takes on what's happening today so you can navigate this market and build wealth. I'm Drew Breneman, and this is the Breneman Blueprint.
With me today is Tyler Hague from Colliers. Welcome.
Thank you.
Great. Yeah, and Tyler's been on the podcast before. It's one of the first guests, came on and crushed it. So
Appreciate that.
Yeah, expecting the same today.
Yeah, high expectations.
Yeah, let's deliver. But yeah, I think in that episode you were closing in on like $1 billion sold. I think for that, it's like the tail end of 2021. I mean, you close out that year with $1 billion sold, or what happened?
We did. We were very fortunate enough we did $1.3 billion in 2021, and then actually last year somehow we eclipsed that by a pretty large margin and did about $1.9 billion in sales in 2022. So it's been an epic last 2 years.
Wow. And then I would think, yeah, so if you want to find out anything about Tyler, how he went from property manager to the nearly
executive vice president, I guess.
Yeah. Yeah. Right. I just call everybody a broker, but yeah. It went from starting out at Colliers as a property manager up to where he is now. You can check out that episode. I think it's episode 3, but I think we just want to talk today mostly just about what's happened since you've been on, because it's a lot what's happened in the multifamily market. So I think why don't you just start us off wherever you like?
Yeah, I actually got a quote that I think is a great quote for the timing right now, and that is in 2023 we will see over-leveraged investors forced to dispose of their assets, with savvy balance sheet investors taking advantage of the market conditions. And what's been interesting about what I just said and the year that we had, or the last 2 years that we had, I graduated in 2007 and, got to watch the whole world fall apart a year after I started working. I don't think that that's going to necessarily happen this time around. But, with that quote, we certainly are starting to see some fractures in the business, some desperation from sellers and past buyers. I think that there's going to be some problems in the multifamily and just real estate space this year into next year. So,
and then for people who aren't following this as much as we are, like where are these problems coming from?
Yeah, absolutely. So it's pretty simple, quite honestly. It was over-leveraged buyers, a competitive market, so they were forced to pay very high prices and low cap rates. And a lot of times they were banking on rent growth and income growth and weren't really looking at their expense growth as well. So, if you bought a property that was effectively priced for perfection, and your expenses move unexpectedly, or your rent growth isn't 25% anymore, things can turn very quickly. And then the last thing I'll say is, rate caps and interest only and maturity dates kind of getting in the way of that. If you have a maturity date on your loan in the next 6 months and, you have a variable rate loan, or just, it's coming to maturity, you're going to be in a little bit of trouble.
Yeah.
If you bought it in the last 3 years.
Yeah. And to add on to what all the things you mentioned with the rent growth slowing and turning negative in quite a few markets, just what happened with everyone who was a floating rate borrower. People who are doing a value add apartment deal, in your markets, let's say paying like a mid 3 cap, and then we're going to stabilize this thing at like a 5 cap, let's say, 4 something cap rate once we're done with our business plan. I mean, that all sounds good when you can go get fixed rate money for 3.5% or put on your floating rate SOFR plus, a 3.5% spread loan when SOFR is at 0. And in November or December, one of the folks from the Fed, I forgot who, but I actually put it in one of those quarterly reports our company made. They had a quote saying like, we're not going to change rates. We don't think inflation will be a problem. And then everyone who was like, okay, let's do this floating rate loan. Because that's what the lenders were sort of, if we're working with a debt fund, let's say you want a non-recourse loan where they're going to fund construction draws. It's basically, that was the only option. They all price SOFR plus a spread. Yeah, you buy your deal at the start of 2022, SOFR is like 5 bips, and today it's like 400. It's 4% something. I was gonna say 400 some basis points, but right. And then your spreads last year blew out too, so you might be 4% plus another 4.5%. So you got a property that makes 4% maybe right now if you didn't have a loan on it, but your loan's 8% interest, and so like that's a big thing too, because I think a lot of the at least especially when we got going in Phoenix, and thank God we all but one deal we did fixed rate through a bank, so we're
Smart.
3 of the, I mean, in retrospect, at the time it's like, well, maybe we should try to juice this more and do something else, but 3 of them were 3.5% interest, and then one that we bought at the tail end as rates had started stepping up was 4.25. So at least all those are kind of make sense from like traditional metrics where our interest rate is below what the yield on the property, so we have positive leverage. But and then the one that we did floating rate, I mean, that was with a debt fund, but they make you buy an interest rate cap. So a lot of people, they'll do a debt fund loan, they'll be like, we want to be conservative, we're buying a cap. It's like, just tell the people they're forcing you to like, you're required to buy it.
Can't get a cap.
Yeah.
Well, I mean, you can get a cap today, but they're a lot more expensive than they were.
Yeah.
And that's one of the biggest problems is that, you have people that either had a rate cap expire or didn't get a rate cap, and, where it was great 2-3 years ago and an attractive rate, now they're getting absolutely crushed, 7-8% interest rates. So
Yeah, and depending on what kind of loan you have, with a debt fund, they don't make you escrow for the next cap you have to buy, but like Freddie and Fannie do. So like your rate might have gone to 8%, and you need to start socking away another, depending on your loan size, 10, 20, 30 grand a month to buy this next crazy interest rate cap. So yeah, it's really amazing how things have changed. I mean, we were on here, 13, 14 months ago, and we're laughing about the Phoenix market, 20+% rent growth. And since then, it's been like flat.
Yeah.
Where it went up more and then it started declining. So, again, thank God we underwrote like 4% rent growth maybe. So nothing crazy. And like the historical average, I think going back to like 2020, it's like around 7%. It's really high. So we thought like, okay, let's be conservative, but I mean, even what we assume for an exit cap rate, it's not there right now. So,
well, I think that's so we were talking to a client last week, and what I found very interesting is they're selling 3 pretty prime assets in downtown Dallas, nice product, well located, and they're struggling to get a 5.5 cap right now in that market.
what year of construction?
At newer product. I
Wow.
think it's late 2000s product. And
And you should tell people what markets you cover too. 'Cause
yeah.
it's a lot.
To take a step back, so I run our Midwestern apartment practice. I'm in from Minnesota to Arkansas, Oklahoma to Ohio. Last year, like I said, we did about $1.9 billion in transactions, sold about 12,000 units in 15 states. And we get to brag that we sold in 2 countries, one being the Bahamas, but that was my business partner's deal. And so I have a partner who's based out of Atlanta who runs our Southeastern and Mid-Atlantic business as well. So together we cover about 30 states.
Nice. Yeah. And so kind of really everywhere in between, you're saying Minnesota and Arkansas. So, because it's not just those states, it's all
east of the Mississippi predominantly.
nice. And then so that's interesting how the pricing on that Dallas deal. Why is it I mean, obviously interest rates, but
The market, I mean, there's not a lot of, there's a lot of equity in dry powder out there. It is being very opportunistic right now. And, it doesn't take a genius to realize you look at the treasuries and the bond market and, a lot of, especially so I have probably 8 or 9 deals right now where I have developers looking for equity for their development deals. And Milwaukee, Illinois, Kentucky, all over the place. And guess what? No one wants to fund development equity today because it's risky. And you can literally put your money into treasuries and get effectively maybe 100 basis point lower, initial return on it, but there's no risk involved. Whereas, if you're building to a 6 or a 7 yield on cost today in the development business, you are taking a lot of risk. Right.
yeah, construction costs and what's that permanent interest rate
Yeah,
going
and
to
the
be?
cost environment's crazy.
Yeah. No, I was thinking the same thing. Where right, you don't know what your interest rate's going to be when you're done, or cap rate, or how much it's going to cost to even build this thing. And right, you can make 4% now just risk free, or I mean, like all these. I didn't go to NMHC, but everyone who went, like their report back is like people pretty optimistic. I don't know why.
It was surprising, and I apologize to Drew on the forefront of this that I'm an eternal optimist, and I'm probably gonna be a little pessimistic today. I have a very good finger on the pulse of the market, and just some of the things that we've seen over the last 3-4 weeks after NMHC scare me. And the funniest thing about NMHC this year was we got a 25 basis point hike during NMHC. They also released that jobs number, I think, a couple days after. And everyone was exuberant and excited about this 25 basis rate hike. And, inflation's over. We're out of the woods. This is going to be a great second half of the year. Last year was a front loaded year. This is going to be a back loaded year. And guess what? That's not going to happen. I think, with a 500,000, whatever, X jobs market or jobs response, we are going to probably end up getting a 50 basis point hike at some point this year, especially with the inflation number that came out at like 6.4%. So, I think personally that to me spells a higher rate hike, not a lower rate hike. And I don't know if I said this earlier, but this funny saying has come out in the last 2 weeks, which is survive till 25. Okay. And that's what large institutions and a lot of our buyers and sellers are starting to say, hey, this looks pretty rocky, and we've been through this before. And a lot of people are battening down the hatches, expect, some problems.
Yeah, I mean I heard the same thing coming out of it, and I mean that's like a play almost. I mean Sam Zell, I think he had to survive to 95 from like the REIT days, but yeah, that makes sense because I mean there's just so much has changed. Yeah, and you told me ahead of time like I don't want to be too negative, and all I said back was, well, the rent growth stopped and interest rates are above the cap rates. I mean, how much can you can't pay the same amount anymore. So
well, and listen, I think for the context for a lot of younger people today that like, look, I've been doing this for 15 years. This is my first cycle. I've never really truly seen a down cycle like as an active broker. And, it's normal to have a down cycle. It creates a lot of opportunity for people that didn't make mistakes. And, when you have 0% interest rates, there's consequences. And the consequences are, you had markets in the Midwest, and I mean, I'm not talking about Phoenix, which was, a 2-cap market at one point, but guess what? That market should have never been a 2-cap market. Middle of Kansas should have never been a 4-cap market. And, we're going to probably restore to the historic trend a little bit, which is okay. Which is kind of what's happened right now is, you asked me about pricing for different vintages and deals. It's tough to buy anything under a 5.5 cap right now. You're seeing some high 4-cap negative leverage deals, but like they're hard. They have to have a really good story and reason someone's coming in and willing to wait 2 years or whatever to get their growth. And that free money market is just it's gone, and it might never come back.
yeah, and I think right because what I was been thinking about recently, because a lot of people, yeah, let's say you buy that 5.5 cap deal today. I mean, that sounds like a very high cap rate compared to a year or two ago. But yeah, when I first started, I think my first loans were all in the sixes. Then rates went up into the sevens. Then they dropped because then 2008-9 happened. And then coming out of that, we were buying in 2009. Our first rate was like 5.5. Then all the next ones were in the sixes. So I was thinking to myself, it's interesting. We think like, wow, rates are plateaued at 5.5. And we were celebrating in 2009. We got a rate at 5.5. So I was thinking like, geez, this is not like rates aren't even that high, and think of all the like potential distress that could happen. So it's interesting, but yeah, I mean, everyone was banking on the growth continuing, and yeah, even like Phoenix, those deals that were 2 caps or whatever. I mean, they were not. No buyer was assuming it's just a 2% yield like only. Like they were planning I'll be able to move my rents to at least the size deals we bid on like to a 4+ cap. I don't buy some of the stuff that's as big as what you sell, like these $100 million deals. So I didn't. What's like some of the lowest, let's say, stabilized cap rates that you saw sell? Because for me, I don't feel like I ever saw anything truly sell in the 2s and 3s. It was always like the year, right now in place might be a 3 cap, but that's because the rents are 15% below market. I was mostly looking in Phoenix. They don't change your taxes, and this will be a 4 cap next year.
Yeah, I mean, listen, we sold a lot of Class A luxury product last year, or the last 2 years, and did a lot of DST business, which is a Delaware statutory trust. It's a 1031 vehicle, effectively, for a lack of a better way of putting it. And that's the hard thing is our bread and butter was selling these Class A deals. They were all trading between a real 4.25, 4.75 cap, depending on location and market, and I guess amenities and quality. So, that for Class A product was pretty, straightforward, and those were the yields that, when we underwrite deals, I'm not really looking at the cap rate, quite honestly. I mean, we do, a number of things to triangulate the value, but cash on cash returns, IRRs, are really what we focus on, because that's where the investors are mainly focused that we're talking to.
Yeah.
And we've seen that cash on cash return slowly tick up and grow. To answer your question though, I mean, we did some very low cap. I mean, I sold a deal in Kansas last year for a 3.8 cap.
But there was loss to lease on
There
that though.
there was, I mean, it was a developer built it. It was, I think, 6-7 years old. And there was huge upside. They're probably getting 25% rent growth on that asset. So, what is the actual cap rate on that? It's probably a 5.5 or a 6 cap.
Well, and that's my point. So assuming no market rent growth, the buyer can get to let's say a 5 cap. I mean, that's where you get all these headlines of like, oh, this was a 3.8 cap. But yeah, that's on the T12 and on the new leases, unless the market totally tanks, the rental market. So that's a risk, obviously. But I mean, a lot of these are,
well, like that deal, for instance. So the way that I would dial it back, and I think from the peak of last January, okay, if you did a deal in November of 21 to January or February of 22, you paid the most money for your property, right? And you probably got pretty good debt actually, but like you overpaid for an asset, more than likely. And so, with that period of time, which is about when we traded this deal, I think that pricing across the board, whether it's Class A, B, or C, is off 20%.
Yeah, I believe that.
Maybe it's 10 to 20%. And, you could say nicer quality assets, preserve the value better. But, what does that really translate into? All these markets are off 100 basis points. It's 100 to 125 basis points. And so let's say that deal in Kansas, guess what? That market was really 100 basis point higher cap rate market than that deal sold at. And so, now we have all these sellers, and it's funny as a broker because, we're desperate to get listings and we're trying to work sellers. And in this last market, everyone wanted these numbers that were frankly outrageous. Buy something in Des Moines, Iowa for $150 a door, like, give me a break. And so anyways, fast forward to today, a lot of these guys that didn't sell, that we had really big offers in front of them last year or the year before, they're actually starting to come back to us expressing regret
Yeah.
and being like, maybe we should have sold, maybe we're thinking about selling now. Because like what I'm worried about for my clients is once we're starting to see distress. I've gotten 6 or 7 large REO deals in the last 2 weeks. Okay. Several are in
Yeah.
Chicago, one in Minneapolis, one in Springfield, Illinois, one in St. Louis.
And these are all multifamily.
All multifamily except one senior housing deal and one office building.
Okay.
Which is a whole other story.
Yeah, because one thing that's interesting, in my opinion, now is I feel like the pricing got so crazy in multifamily, and then the debt, there's so much variable rate interest, floating rate debt, that like now we're actually for once, going to have some distress in multifamily where. Like when I was buying in 2009, we couldn't find any distressed multifamily deals. I know they existed, but for where I was looking and the deal sizes, I wasn't finding any. There was plenty of empty retail that got built on the last farm in any city, like that shopping center that Starbucks signed a lease on the end cap and they never rented the rest out. Like, yeah, there was 20 of those to buy in any city. It felt like, but I didn't see any multifamily, and this time it's almost like the pricing got so crazy. Like there's going to be, as much distressed potential multifamily as anywhere.
Yeah, I mean, just look. I'm not going to say any specifics because I have a real deal that has this problem right now. It's an institutional deal. They have a maturity date in June. There were some issues in the market and the location, so it's 75% occupied, and they have a huge conundrum. It is, do we sell it for $70 million now? Do we hand the keys back to our bank? Do we, they're not in a great position, and this is otherwise a very well capitalized seller, very smart, astute investor, and literally the timing is just bad for them. Where they're not going to be able to refi out of this deal without showing up to the closing table with a check.
Yeah.
And that's, what I think the beginning of this trend is going to be is people go to refi, they can't. People go to sell their buildings, they can't get the number that they want, or maybe they're not satisfied with it. And so people are going to have a real, decision to make. Do you, take your medicine and sell your deal for maybe even a loss? Which, of course, the broker would always say is the right thing to do. I do think it's the right thing to do because once that snowball effect starts, and you and I got to see a little bit of it, that pricing can get decimated very, very rapidly. And it's not bad for just that borrower. It's actually bad for the entire market because your values also technically, if you didn't have fixed rate debt, if you have fixed rate debt, you're kind of like, pack it away, who cares? We'll wait. But, if you have like I was at the servicer conference in November, a lot of people are saying that if the debt environment stays elevated through 2025, which is a huge maturity year, you're going to have even more problems because, if debt rates are 6% in 2025, practically all those people who originated those, not all, but a lot, 75, 80% loans, paying a pretty penny, and they're going to all get to the end and be like, what do we do? Do we write a check to keep this asset, do a capital call? So
I know one thing we've noticed when we're underwriting, and you can see where, I know this isn't probably what you're talking about from where it's like a vicious cycle, because you're just thinking, okay, this deal last time it sold for $300,000 a unit, and now finally one clears the market at $225. Now everyone knows it's worth $225, but what's also crazy is the person who is, let's say, paying a 5.5 cap and paying $225. If you're going to underwrite the way people normally underwrite and then trend your cap rate up, now what, you got to sell it at a 6 cap when you're done, and it's like it makes you can't pay as much because you're. It seems like a steal at 225, but that's because you still have your like old cap rate hat on.
Yeah.
You're like, well, pay a 5.5 and I'll sell it for 4.5. Maybe that'll happen if interest rates drop and the rents start running up again, but you don't. Nobody underwrites like that. Everyone would throw your spreadsheet away because they'd be like, "What are you doing?" No one assumes they drop. So that's one thing too. That's like a kind of a crazy thing to wrap your head around. Where um, you need to, if you're trending up your cap rate, it's like, wow, what are we selling these things for? 6 something?
It's never been harder to value a deal as a broker than it is right now, in my opinion. We are like, I got so spoiled with even though the last market was difficult because we were selling expensive stuff and jamming it down people's throats all the time. Um, this market is a very dynamically priced market. It is almost like you're pricing these deals every day. I could do a BOV today, and in 2 weeks, that pricing almost isn't realistic anymore. You had treasuries move down to the 350 range. Deals started to tick up and happen really aggressively. I didn't look where it was today. But
And it
last
got
week
close to
it was
4.
going up
Yeah.
to 385 and deals died. Like my debt guys were like, the market's kind of dead, above 375. And so, it's just like, it was never like that before.
Yeah.
You could practically, I could do a BOV for you in 2019 and 30 days later, like it was relatively the same value unless something significant had changed, right? And so I think that has been a huge challenge. And, actually a segue from what you were saying before is Chicago, which, we did 47 deals last year. I think 5 were in Chicago. Um, we're trying to do more. We're going to actually have, I think, a pretty significant year in the city this year. We've already got a lot more listings than we did last year for a variety of reasons. And the interesting thing is you saw some deals trade last year, the very few ones that did, for 2000. I think one property sold for its 2011 value, a tower in River North or Gold Coast. And so, what does that say about the market? And it's hard to underwrite everywhere else, and then you go to this market, and it's almost impossible.
Yeah. I know. At least it feels so. Then you think there's more distress in Chicago than, let's say,
Oh,
your
yeah.
average place? Okay.
I think there's, what's funny is, and my business partner will be rolling his eyes as I say this because I beat the Chicago war drum all the time. I think relative to cost, and just fundamentals, Chicago actually has a really great value proposition across every spectrum except for one, which is taxes,
Yeah.
right? And unfortunately, our assessor has gone through this process that didn't really achieve what it was supposed to, and it actually hurt a lot more people than it ever was meant to. But I think that there's, you can get rent growth in this market that you can't get in even some of these places, like even in Austin, Texas. If you boil it all the way down, Austin, Texas is a small town. It's got a long way to go before it reaches a Chicago kind of height. And we'll see if it stays, as red hot as it probably will. I'm a believer in Austin, Texas, and I'm not comparing it to Chicago by any means. I just think that the values in this market have been beaten down so much that we're probably starting to approach a place where some of the institutions might start dipping their toe back in. The downtown office problem, though, is gonna kill the apartment market because you got 15 towers in foreclosure. My client just took over the receivership for a property in the heart of downtown. And then there's a couple others that I know of. So I think that the taxes effectively have, pushed some of these landlords to the point of no return in Chicago.
Yeah. I mean, and the assessor here has created so much uncertainty where, I mean, this started in like 2018, if I'm from memory, of just the talk about how much he's going to raise the assessed values. And then some of those stick when you appeal, some don't. And then you get all these anecdotes of like the guy who owns a guitar shop in Evanston getting his taxes tripled and all this like other effects where, it's really not, it's created so much uncertainty. It's definitely done. It's not helping.
One person And I'm not gonna, we'll give Lori Lightfoot, I guess, no credit, but I won't say anything ill about her right now. He's effectively cost the city of Chicago billions of dollars in investment, and the tax revenue lost because of that investment or lack thereof. I mean, has been pretty sad.
Yeah, I mean, well, it just introducing all that uncertainty then makes people not invest here. If you're going to build, a high rise here, and there's no way you have almost no clue what your tax is going to be.
No.
Like people have estimates, and like I know all the rules of thumb people use here and we use, but it's always it's rare that it ever hits these common amounts. Like a lot of our taxes are well below that, and then on some deals we're way above it and getting smoked on it. So and then if you're building a new building, at least for us, we're buying existing, so we can kind of look and say, here's the taxes today. Here's where we think they might go. This doesn't even have a tax bill yet, and the assessor's going to look at it and give you a number when you're done, and so you're going to get
You have to
hit.
hope for the best.
Yeah.
Well, and again, maybe another good segue is, that's why my business has been, has grown so much is, we're taking a lot of capital, and sadly in Chicago that's leaving and going into, where do my clients really want to be? In red states. They want to be in places that, have more lax, tenant landlord laws than Chicago. And I think that where you and I are going to disagree is I actually think that there's probably more risk in Arizona and Florida and some of those growth markets. And I told you that I really like Tennessee and Kentucky, and Ohio to that effect. And Tennessee obviously has the same general tax laws and income state tax laws as Texas and Florida, with less risk from an environmental perspective. But we had a huge year in Kentucky last year. I think Lexington, Kentucky is one of the best markets in the country. Louisville's a great place to invest. And so we've just been spending a lot of our time taking, that's the beauty of our business is we're moving capital around the country and bringing, new clients into new markets that they otherwise wouldn't have been in. And with everything that's happened on the coasts and in these growth markets, last July, the market does, pretty much overnight dissipated. All these debt funds and the warehouse lines kind of dried up overnight. All the big institutional LPs dropped out of the market, and some still haven't come back. And so, the only places that get them out of their seat and excited are like Tennessee, and you can still get people excited in Texas, but Florida's had some huge cost expense problems with insurance and other things that are starting to eat into NOI growth.
Yeah, I mean it's interesting. That's something we've done. Well, we've had most deals don't pencil. We've reevaluated what markets we're going to target, where we looked at a ton of stuff, just the population growth, job growth, what's actually correlated with price appreciation, how the single family home market's done, what did it do in like prior recessions from like a stability standpoint. I'd be curious, so what would you say? So I agree with you on like a lot to like it with Tennessee, the Carolinas, Kentucky, where those you're getting, especially Tennessee, you have a no tax state, you're getting all this population and job inflows, and you don't have as much cost at the property level risk. Mm-hmm. So property taxes are not they're not as bad as, let's say, Texas or here. Insurance is more stable than, let's say, Texas or Florida. So I get that. So what, maybe take me around. What do you like? What do you not like today?
Yeah, I mean, Ohio and Kentucky have some, you have to do a drop and swap in those markets, which is a entity sale transaction to help, avoid tax reassessment, where you're buying the corporation effectively.
And in what states?
Ohio and Kentucky specifically.
Because they just chase the sale then, otherwise?
The school boards actually will go after you. So you used to be able to, I think, negotiate ahead of time with the school boards, and now you can't do that anymore. And so, that's the problem with Ohio. it's got a very complex kind of tax situation in that market, and the reassessments, they reassess you pretty significantly upon sale. So, I mean, I had a deal 2 years ago we sold that, taxes went up $750 after the sale. So
$750,000.
$750,000, yeah.
On what kind
which
of
takes
bill?
a little bit of a hit to your, to your NOI. I mean, I don't remember what it was. It might have been like a $300,000 tax, and it went, up to $1 million or something. So it's
that's
on par with Chicago. It's more than I just underwrote a deal in Cincinnati. I think our reassessment had taxes at 22%, which is higher than Chicago technically.
Yeah, the issue with Chicago and Cook County is the uncertainty.
Yeah.
I mean, I've bought a ton of deals in Minnesota, and
Yeah.
it's the same. The tax rate as a percent, like your tax bill in any metric you look at, is higher in Minnesota, but you know what they're going to do. They're going to chase the sale. It's going to be 90 to 100% of what you paid.
Yeah.
So then you can just underwrite that. Wisconsin,
Correct.
it works the same way. Just assume they chase you 100% basically there. Same thing. And then that's one of the things that drew me to Phoenix was there they don't chase the sale, and you just underwrite 5% increases every year. So you at least know what you have. These states where you don't, like Illinois and Texas and Florida, it's exhausting.
Yeah, it is.
Where it's just a guessing game. So then what don't you, if we do disagree then on Phoenix, so what don't you like? Is it going to be supply?
Yeah. I mean, it's the, and look, I've done enough research to understand that some of the employment, I mean, what drives our business the most? It's employment. And so, the markets I like the most are, and especially as a broker, I love college towns, but, good college towns that have a capital like Madison, which is exactly why Madison's such a great place. It's why Lexington's such a great market. Those kinds of, meds and eds, they have a large university that has lots of employment. They have, smart people that live there. And then they have a large medical institution that also employs lots of people and other businesses. And so, in Phoenix and, Arizona, I just the overbuilding, the low cap rates, and when everyone starts to flock into one specific market, and you start to see, Chicago people who have never invested anywhere else all kind of go down there, it makes me take a pause and a step back a little bit. I think that there are great parts of Arizona and Phoenix, and and like if I was in there, I'd probably have more of a workforce housing strategy, because I feel like, it's kind of like Austin. Like my father-in-law lives in Austin, and it's insane how the pricing of houses in Austin, when you have people in a market that are born and raised from that market, and they can't afford to live there anymore, or teachers can't afford to live in the market that they're supposed to serve. I think that's, an indication for me at least that, like, perhaps, you should start looking elsewhere. But, Intel's building a pretty large facility just like they are in Ohio and in Columbus. And I mean, the Columbus market has absolutely exploded because of that Intel facility. However, it's also sucking all of the materials out of the market and has made costs kind of unbearable. Like I read that, I think this Intel plant in Ohio is going to take like 90% of the concrete or something for the like state or something. I mean, it was some like outrage, because it's such a large project.
And tradespeople. The same thing happened when I was a kid in Milwaukee. They built Miller Park or whatever it says, name changed to now, and like my parents needed an electrician to do something in our house, and they couldn't find anybody, because they're like, no, they're all basically working on the stadium right now, or then like other commercial jobs. So there's no like people that come to your house almost for a minute.
It's a kind of a wild problem. You want those jobs, you want them to come in and do what they're supposed to do. But then when you realize that it actually has a huge impact on the labor market and on the materials market, it can be problematic as well.
Yeah. One thing that's been interesting with Phoenix, and I wanted to, I just pulled it up on my computer to make sure I have the right percentages, but it's had it's had like strong growth for a lot longer than I realized. Where like, so 2013 to 2019, so no COVID, no recession, just what's like a normal time. their rent growth during that time was 7.3%, and same time period appreciation was 14% a year. If you go back 2000 to 2019, appreciation was 7.4%, and then the rent data went back to 2005 that we got. So 2005 to 2019 was 4%. So what I kind of took when we started going there was, it never got my attention until I realized how the property taxes worked. And then you look and you go, actually, this is kind of always, it's been growing. It just got such a bad rap in the last bust. And, we'll see how the employment holds up. I mean, it's a lot more diversified now, but it does have a lot more, it still has like such a long history of volatility. Like there's definitely no doubt about that. I agree with you. Like we haven't bought any Class A deals or nothing even close to it there, because it's, the way I always thought of it is they do have a lot of building there, but it's actually just right in line with average for the Sun Belt. Right now, it's 7.9% units under construction as a percentage of existing stock, and the average for the Sun Belt is 8.1%. We pulled that from this CoStar 2022 data.
And I would also say, to be fair, I'm basing, some of my opinion off of what happened last time. I would admit that, that was a single family overbuilding problem that obviously, like Vegas, for instance, I think Vegas could have some problems too again, but they're experiencing some good growth as well. And so from the single family housing market's really what caused the last recession. We haven't had an impactful problem in the apartment space and in Phoenix, and with that kind of growth that they're experiencing, my guess is absorption of units is still pretty strong, and even though you're underwriting 4% rent growth, you're probably going to exceed that, is my guess.
Yeah, well, it's what's interesting is how I always thought of it is, so I agree with what you're saying, but it's also like the last deal we bought, the 2 beds rent for $1,750 a month, and then across the street diagonally there's a newer building that's like a year old, and they rent for $2,650. So I always kind of felt like, okay, I get it, like 8% is under construction, or 30,000 units if you want to like freak people out with a big number, but we're not really competing with the same renter. So then I actually start to get worried about Class A, because you go, how many people can really afford these units? And maybe that's like a 10% of the market can afford it, and now you're going to pile in, you're basically going to like double the inventory every year, or not every year, like with what's under construction in all these Sunbelt cities. So then it's like, that's why we focus more on like acquisition rehab deals. So you end up with like B and C product, let's say. But then those are like older buildings, so that's not perfect either. So it's been, but I can see that where if you sell a lot of developer built trophy stuff, I can see where they're going, yeah, we thought we'd hit this rent, but rents have dropped now because there's a lot of supply just anywhere in the Sun Belt.
Yeah, no, I mean, I think that's, look, that's part of the problem with the dynamics of the market is, because of the cost environment, if you're building something, you can't deliver workforce housing, newer workforce housing product to people without buying a 1970s or whatever property and fixing it up and doing a value add on it. And all the development that has been, done over the last 5 years has all been ultra luxury, super expensive, rich people apartments, right? For lack of a better way of putting
you're
it.
right. I mean, a lot of these we're buying them, they're renting them for $900. We're making them like $1,300 apartments. That deal I was just quoting, that's like our highest.
Well,
rent,
and that's
I
the
think.
most important, that's the largest and most important housing stock we have is workforce housing. And look, there's an affordability issue everywhere. I wouldn't blame it all on real estate professionals. A lot of it actually is taxes and other things too. But
Yeah, no, I hear you, and I think too, it's interesting just how different each city is, and like when you're talking about Austin and like will it be able to sustain like this kind of growth, or what's going to happen. And what's really interesting in Texas, and it's a function of the operating costs, like the price per unit for what you're buying, it's like pretty close to replacement cost still. I was listening to a different podcast, and he said he talked to these developers that have like thousands of units under construction in Texas, and it's 230,000 a unit to build new now. And you see these things sell, and they're like 250-ish. Like, it's not a crazy spread. Where that was one thing I didn't like about Phoenix, is you would see these deals where maybe it would cost 300,000 to build it, and there's deals in Scottsdale selling for like 700,000 a unit.
It's crazy.
And you're like, I definitely don't want to put my money in that one. Or you feel weird buying your Class B deal at pretty close to a replacement cost to a new one, going like, how does this make sense? But it's kind of hard to wrap your mind around. But I have like an old tax bill where we bought a $26 million property in the Phoenix area. Our tax bill is $25,000 a year. We're in a building right now, that we paid a similar amount of money for, and the tax bill is $600,000 a year, $525. So like, what is that? I mean, it's the 20 times higher, you know, in just in terms of your dollars. So that's also why these old buildings sell for high price per unit. So a lot of these things that like I was worried about too, supply, price per unit, once I started like actually working there, like I kind of overcame all that. And the same thing happened where we're starting to look in Dallas and Austin now, as well as Nashville. We have not hit the Nashville. That's why I haven't heard anything from me about it. The Nashville, like we took a pretty exhaustive look at all the markets. Let's say like the top, like I think it was 37 cities in the country, and we tried to make something that would, and we did. We could back test and see what variables were correlated with appreciation, and then set like a score. Where I think anyone who's listening to the podcast know we got a guy who works here named Evan, who for fun made a model that could predict or could optimize your March Madness brackets and his hobby sports analytics. So we just he just ran with this and made something similar for the markets. And without saying just one by one what were our top markets, what made sense for us and where to look, thinking about how they work with each other, was Phoenix, Dallas, Austin, Nashville, Charlotte, and Raleigh were where we wanted to focus.
I'm surprised there was no Carolinas in there.
Well, and the thing is, what's interesting is why not Florida or Georgia or Atlanta? Like, those are strong markets too, but they're volatile, and we're already in Phoenix, which, you know, if we were going to say what's the most volatile markets, it's probably Vegas, Phoenix, anywhere in Florida, you know,
Miami.
Yeah. So like, we're already in one of those. We picked the one that has in my opinion, some of the best employment and the best taxes, best operating expense situation. Because Florida is like, just cross it off the list almost for me, because it's getting close to where you can't get insurance now.
Yeah. No, I you know, we had a client telling us about how the, you know, costs. This is another thing that I guess is quasi-negative. You know, look, people and brokers are at fault to this too. Did not underwrite their expenses adequately. They underwrote 3% rent growth, 3% growth in their expense assumptions, and they're now getting 5 to 10% or maybe even more in some circumstances. And so, you know, in Florida, you have a lot of people that were paying $1,000 a unit, or maybe it was $1,800 a unit, or, you know, it certainly wasn't $3,000 per unit for your insurance if you can even get it. And that's happening, and people are getting, you know, hit with NOI, deceleration when they're getting huge bumps in rent. You know, we had I told you the story before we came in here about, you know, we have a client who got 50% rent growth on a deal in like 8 months, and their expenses are outpacing their income.
That's wild.
And so, you know, they're going to be able to sell the property and still do okay on it. But, you know, still, it's like, you know, the amount of cost overruns that they're having, and that's not atypical to a lot of other people where you've tried to hire people and you know, get refrigerators and, you know, I feel like the front end of inflation, you know, you kind of like, we talked about it and you pretended like it maybe was happening, maybe it wasn't happening. Like, I have 2 kids. Going into the grocery store, buying products, you know, everywhere you look, your costs are significantly higher, and it's starting to actually, you know, hurt, right?
Yeah.
Like, it's noticeable, especially when you have a 300 or 400 unit apartment building, and, you know, you got to pay $3,000 a unit for insurance all of a sudden when you budgeted 2,000, right?
Yeah, I mean, it's the inflation's been a big thing where I feel like insurance is almost its own animal, where that's like Florida, Texas,
And
California. There
it'll
have been,
come back down, right? Like the insurance companies got crushed the last 2 or 3 years with lots of losses, and so it's cyclical also. But
yeah, but what's wild with Florida is you'd have, I mean, probably 5 years ago, insurance was like $700 a unit, and now it's like good luck even getting it
yeah,
almost, or it's going to be 2-3 thousand. And again, to go back to why Phoenix is so great on that on that $25 million deal, my insurance, my insurance is like 20,000 a year kind of
yeah.
thing. So I'm paying 200 something a unit for property taxes and 200 something a unit for insurance, and so whereas in Florida, I mean, that those two together, what could be 7,000 a unit.
My only and this will be the last bad thing I say about Arizona, I promise, is water.
Yeah.
That is the only other, and that's my big Chicago puff my chest out. We have a big lake with lots of fresh water. The 50-year view here is good.
I do wonder
It-
about that. Yeah, it's
it-
interesting where everyone's moving to the south, and I mean, more than just Phoenix is on the Colorado River. I mean, there's Salt Lake and all these other places drawn from
Well,
it.
there was an article, I think it was in the Wall Street Journal a couple weeks ago, and it was talking about, and you should be scared of this.
I know. Oh, dear.
Private equity starting to buy riparian rights on rivers, and and effectively doing so to control, from an economic perspective, the release of the water and selling the water. And so, I don't know if that's an ethical or moral problem per se, but it's kind of, if I was a landlord probably paying a lot of money in water already in those markets, and then KKR or something comes in and buys your water rights, I'd be a little afraid. But that's a long-term problem. Theoretically, it's not gonna, you have to restrict some water access to your, like, actually, what do you do in your properties? Like, do you have grass at any of those properties? Is it all, are you actively I assume you're trying to deploy strategies that reduce water and
Yeah, we are. The first. So what's wild to wrap your mind around if you're from the Midwest, like basically every plant on your property, it needs a line of water running to it. Like otherwise, it's not going to make it. Even like a desert flower. So there's irrigation to literally every plant on the property. So like just a little plastic pipe in the ground, and that'll just drip water on it. So once you have your head wrapped around that, you go, okay, we're redoing our landscaping. Well, what plants don't take a lot of water? Like, let's use those, because any plant will need water sent to it. And I think only one of our properties has real grass at it, and then the sprinklers go on every night to keep that alive. So, but yeah, that's a bigger property where there's like two large courtyards where, I mean, we have quite a bit of just rock and desert landscaping there as well, and with grass in the middle. But yeah, all the other ones, there's no real grass, but you're still shooting water at all those plants, which is like surprising, because if you grew up in the Midwest, like you're not really watering your bushes.
wasteful.
But if you are there, it's like, if that water turns off, your flowers will be dead in like a week. Yeah, it's interesting. But yeah, I think that I agree with what you're saying, and it's kind of crazy that in a way everybody's moving to the Sun Belt, yet we have global warming. We got to think about water. Texas is having power outages, and you can barely get insurance in Florida, but everyone is going to these places.
Yeah.
So
Yeah, it really is. I mean, it makes you wonder. And again, I'm playing devil's advocate a little bit on some of this. I think the growth is real. I don't think that people are going to be moving back from Florida to New York anytime soon, or from Dallas to California. I think that people are going to those states because they have more freedom than a lot of the other places, whether it's tax freedom or just personal freedom. We're all Americans, and we don't like to be told what to do. And unfortunately, in New York, Illinois, and California, we have lots of people that want to tell us exactly what we're supposed to be doing with everything.
Yeah, and the cost of living's higher.
Yeah.
There's more crime. Like it's just, it's interesting. When I first again started looking in Phoenix and then in let's say in Austin, I asked people where like the shootings at, where should I like avoid. In both cities, it says we don't we don't have that here. Like
Yeah.
there's nowhere to go like where you'll have that.
Yeah.
And then what about carjackings? You know, like we no, we don't. Like I'm sure they're you know that happens, but it's like a rarity. Whereas here, like hundreds of cars are stolen
Yeah.
a day at this point in
It's a
Chicago.
big problem.
So there was something where there was a chart of cars stolen as of January 20th this year, and it was into the thousands in Chicago.
Thousands?
Yes, yeah. It was mind-boggling. Where you're like, I have no clue, and where it's starting to get like it to affect people I know. Like one person, a friend of a friend was kidnapped. Yeah. And so it's not just carjacking now. They'll take you in the car and start going.
Listen, I think that and it's not just Chicago, by the way. And I hate to even say this, but like Minneapolis, I have a couple deals in Minneapolis. I have a deal in downtown Minneapolis. It's a disaster right now.
Yeah, nobody wants to be down there.
It's almost worse than Chicago. And you know, the problem with these big cities, and sadly mainly liberal, are that, you know, we've got away from deterring people to not do and commit crimes. And I think that, you know, coming out of a pandemic like COVID, where you saw the vacation of downtown urban areas, and, you know, no one wants to go into their office and work anymore. Well, when, you know, I moved to the suburbs 2 years ago, I love working downtown. I like going into my office. I want my employees in my office. I think it's meaningful. I mean, the city gives me less of a reason to come downtown every time there's a shooting or a carjacking, or, you know, I'm not afraid, and I don't think I'm taking a risk or anything. But, you know, in the unlikely event something happens, you know, it's up to the city to protect us and to make us feel safe. And until they're willing or able to do that, I don't think you're going to see any of these urban environments come back, because, you know, all it takes is one of your colleagues, something to happen, and then you're like, well, I'm not going to go in the office anymore. Like, why would I come downtown? It's dangerous.
Yeah.
And it just, you know, it spreads like wildfire.
Yeah, or once you have kids, then you think about that too.
Yeah.
And we both have little kids, and you know, what could happen to them here compared to, you know, one of these other safer Sunbelt cities. So yeah, no doubt. Definitely agree with all that. I mean, these people that get arrested for carjacking, I mean, it's like a lot of times they'll say like this is the fourth time they've been arrested for this. Like
fourth? It's like
or
the
ninth or
30th.
10th or yeah. But either way, it's like we're still like, and then they'll be out and committing a 31st offense, and, you know, and then, you know, so, all right, enough of that. Predictions for multifamily. Let's say what's the rest of this year look like? Maybe next year.
So I think, look, I think that so we've been really busy. We've done a ton of BOVs lately. We're starting to get some good listings. I think that there's a lot of hope, but hope is not a strategy. And I think it's going to be super slow through June, July. I think that you're going to have a decent end of the year and back end of the year. I don't think it's going to be anywhere close to what people think it is. And I think you're going to see some real distress start to hit the market midway this year. And I think that distress, whether that becomes, you know, endemic or not, I don't know. But what I do know is we are seeing a lot of action from a multitude of servicers, a multitude of receivers, in a multitude of locations. It's not just Chicago. It's, you know, all over the Midwest. And it's also just not apartments. It's, you know, the funniest thing about all of this is, you know what asset class I think is going to outperform every other asset class?
I'm going to guess retail.
Yeah.
Okay. Yeah, because the people are so conservative with their assumptions. They're already in that market thinking the glass is half empty, whereas in apartments or industrial or storage, it's all just to the sky.
Yeah.
Was the last, you know, whatever. 3 years.
Yeah, and I look. I think that, and I hope I'm wrong. I think in July, August, you're going to look back and you're going to see some real problems and some real fractures and some real oh shit moments, and it's going to be the beginning of a real downturn and dislocation in the apartment business. There's a ton of capital ready to buoy it right out. I think a lot of these banks and servicers are going to liquidate. This is not pandemic. There's no kicking the can down the road. I think they're going to just chop these guys off the knees and liquidate their assets, which is good for the market, actually.
Just to take your medicine quicker, or why is that?
Yeah,
good? Okay.
I think, look, there needs to be a pricing reset in our business to a certain degree. There's a huge bid-ask spread differential between buyers and sellers still. Sellers are stuck on cap rates that aren't real and aren't coming back. And if you look at the office business, so I've underwritten like 4 or 5 office buildings that probably would get converted, all REO deals. And actually, I'll say something about another deal in a second. And like these properties, I looked at a deal that had $120 million in debt downtown. I underwrote it for 60, and our office team underwrote it for 30. Okay, think about that.
Wow.
And I sold an office building in REO in December. The seller wrote a $26 million check at closing to get
Wow.
that deal done. And so
lose all your equity and add 26 more just to get out of it.
And it was a REIT, so they could, and they did it for obvious reasons. But the point is, I think you're going to see some serious shit go down. We are well overdue. The market's ripe for it because people were over leveraged and overpaid for deals. And unlike you, who is a very astute, probably way too smart for real estate type of person.
I don't know about that.
There's a lot of syndicators out there who are, maybe some are bad people, maybe others aren't, that effectively, just took a lot of fee. They took equity from people, bought a lot of properties when it was convenient and good. And, guess what? They took fees. And at the end of the day, if they get wiped out, they still took fees. And they're not really on the hook for the problems.
Yeah.
It might be harder to raise money in a couple years. But, I think that's where you're going to see the biggest problem is secondary, tertiary, 80%, bridge debt guys that come through to the end and they're like, oh man, I bought this for $150 a door. It's worth $110 a door.
Yeah, I can see that. Yeah, and they have these people running ads online for 30% returns and all this stuff. And now
I have to hold everything back to mention a certain someone. So
yeah, but then this stuff isn't going to materialize. And what's ridiculous if you're in our seat is it's not going to happen. Mm-hmm. But they're over here raising money, making these ridiculous promises. Yeah, so we never did that. And even the stuff I just have never. I think out of the 40 deals I bought, 2 of them I've won in like a best and final situation. Otherwise, we're usually buying more in like some sort of off market through a broker scenario. Or like repeat sales, like once you buy from someone, then they're like, hey, just send this to Drew. Let's see what he'll offer on it.
Which is good for you because, we had deals last year. You had 30 people showing up. You were taking 8 to 10 of the best and final. You were getting, $500,000 hard money day one, no questions asked. Those days are kind of, they're over effectively.
Well, yeah.
But that pushed people to make bad decisions.
Yeah. And so I just never have been able to, those deals don't make sense if they're, marketed as well as you guys can do. So they get it, they have by the time you get to the 4th round, it doesn't make any sense anymore.
But like to finish my prediction, I think that survive till 25 is real. I think that, you have expense problems. And I think people are asset managing this year. Like this large institution literally told my business partner, like, don't call me. We'll talk to you in the 4th quarter. Like, we're not buying shit this year.
Yeah.
Like we are asset managing and making sure that we can survive and everything's good. And so I think, some capital is going to be deployed this year and there are going to be transactions, but you're not going to know how bad this is until the end of the year. At the end of the year, we're going to either look into 24 and say, oh my God, this is going to be a bloodbath, or okay, like we got past some of this, it's okay. And we'll see what the Fed does, right? What's your Fed prediction for this year? I'm kind of curious.
Yeah, well, I think what's gonna, I guess the one thing I want to ask on all the stuff you're predicting. So then, let's say your 5.5 cap generically is where things are today. It sounded like
It's going to a 6.
it's going to a 6.
Yeah, it's not going. Cap rates aren't going down.
Yeah, that's what I wanted to pull out of that. I mean, I think the my prediction on what the Fed does, I think, I bet they're gonna have to cut rates sooner than people realize. And I don't have much money on this trade, so to speak. We just have one variable rate loan with an interest rate cap we're getting paid on, so it's not gonna affect me until we get below my cap. But they're gonna cut, I bet, quicker than people think. Because
This year?
no, I think in 2024 at some point. But what we're going to see, I think, is at the end of this year, you're going to have a moment in time where interest rates peaked, organic rent growth was done being flat or stops being negative, depending on what market you're in. So you're going to have a moment in time with this, call it sometime around the end of 2023 to, let's say, that point in 2024, where it's going to be a really good buying opportunity because you have interest rates peaking, cap rates peaking, maybe all these REO deals you're talking about being dumped, and then organic rent growth is going to pick back up. I mean, you heard what the averages were for Phoenix. These places, they've been 5% plus for a long time. And not to mention now, who's starting a new project right now for new development? So then take 2 years on from now, and there's going to be very little supply coming in 2025. You already had interest rates peak. Organic rent growth is going to be really big end of 2024, 2025. So I think it's things are going to change fast. When it will be exactly, I have no clue. So we're just staying.
No one does.
We're just staying ready, underwriting, ready to buy when something makes actual sense. But I think when that moment is when you see rent growth start again and interest rates have actually peaked. You got a false start, like you're talking about, where the Treasury went down 50 bips, and then everyone's getting active again, and then it goes back up, and people are like, oh wait, we're not done, and then the inflation comes out higher. When that's over with, that's like now we're on like in terms of backside of like timing being good to buy. Whether or not we're flooded with distressed deals or not, I guess
that's the real question, right? I mean, that in my opinion, that's the big outlier, right? I don't know if that's going to happen. You don't know if that's going to happen. But if it does happen, it's going to create a pretty substantial drag on pricing. Right?
The other thing that I heard a lot from NMHC was pref equity. So then if you're able to just kick the can down the road, say, okay, this deal I bought for $25 million and borrowed 20. If I sell it right now, I'll get 20 and have to walk away and be in an embarrassment. Or I can bring in this pref equity and I'll pay them 12% interest on this, but at least I can refi my $20 million loan and have a chance to have something great happen in the next 3 to 5 years. So I think a lot of these deals that are you're thinking might be go to REO, like they could somehow refi with bringing in a new partner, pref equity, go to some of the existing LPs, do a combination of that. So might be more options than there were in 2000, let's say 9, when just everything stops for like a year.
I agree with you. I think it's, the only disagreement in that I would have is I think that, and what I've seen thus far in maybe some similar circumstance, is the reluctance to cut their deal and to say, okay, it's 90 cents on the dollar, it's 8 or whatever it is. People don't want to take that discount now. They feel like, the fundamentals for our business are exceptional. The rent growth comment you made is like spot on. I think that's kind of the problem, is everyone sees, there's an affordability problem. You can't build enough units fast enough that are affordable. That everything is, really lined up for a pretty good 10 to 15 year run in our business. But the pref equity and, there are a lot of kind of lifelines out there. I just wonder how many of those deals actually get done with that 12% or
Interesting.
like, I mean, I feel like people might go down with the ship before they almost do those deals or wait too long, and then those deals are
It's
too
too
hard
late.
to come by or it's too late. I don't. It's
feel
going to
like-
be really interesting to watch this happen. I mean, and I'm kind of excited, whether it's good or bad, to see it because, again, the last cycle was very different than this, and it's not like there's something wrong with our business, fundamentally.
Right.
So,
Yeah, I mean, it'll be interesting. I mean, a lot of these lenders, though, they really want to work with the borrowers and not be taking
Yeah.
the property back, doing, taking it on themselves. So I think if you're talking to your lender, you get more time and you'll be able to bring in pref equity, bring in a partner.
I've had two
know.
foreclosures in the last week that happened like that.
Yeah, that's
Like
that's
that and
surprising.
that's why I feel a little differently.
Yeah.
Is like,
Well, that would make me feel differently
Yeah.
too. That's very surprising because
yeah.
especially
and
depending.
and borrowers just literally just get like, we're done. Like, we're
Okay, well
giving
that's
up,
why.
we're outta
Okay,
here.
that's why it's so imbalanced. Where because I would have guessed that's not the borrower driving, or sorry, that's not the lender driving that, because
No.
then that's whoever originated that loan is going to be like, wow, I can't believe they did that. I don't want to send more people to them. Where there's a whole like reputational side
Yeah.
of this that's never talked about. Where if you're that one debt fund who just borrowers want to work it out, and you're just like, no, foreclosure, like no more debt intermediary is going to bring you good deals.
Yeah.
So that's like another side. That's why, okay, the
These were
borrowers
both
gave up. Yeah,
borrower led. Like, we're out, we're done. Like, here are
that
the
makes
keys.
sense. Where,
Let's get this away from
yeah,
us.
okay, I got it. Or yeah, we bought a 2 cap, thought rents would go up, and
Yeah.
they didn't, or what? Okay,
Both timing situations.
yeah. All right, let's wrap it. How do people get a hold of you? Where do they go?
You can call me or email me is the best. I'm always available.
Cool. All right, yeah, we'll put this content info in the show notes here. So awesome. Thanks for being on, Tyler.
Yeah, thanks for having me.
If you learned something from today's show, leave a review and hit that subscribe button wherever you enjoy your podcast. Dive deeper into real estate investing on Breneman Capital's website, breneman.com, where we have numerous free resources and information that can help both active and passive real estate investors. Accredited investors can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Breneman and guests as of the date of recording and do not purport to reflect the views or opinions of Breneman Capital LLC and its subsidiaries. Views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities. The speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.